Have you ever noticed how some investors stay calm even when the rand tanks or political headlines feel like the world is on fire? Here's the truth most South Africans don't talk about. We live in a small economy. South Africa makes up less than 1% of the global GDP. That means 99% of the world's investment opportunities lie beyond our borders. To put this in perspective, Tesla, a single US company, has a market cap almost as large as the entire South African stock market. One company, one country versus all of the US. And yet, most South Africans still have nearly 100% of their wealth tied into one country, one currency, and one set of rules. That's risky. I've seen it time and time and again. Take Peter, a successful entrepreneur and one of my clients. He sold his business, paid off his properties, and retired in early 2021. But here's the problem. Most of his retirement savings were still in rands. By early April 2025, the rand had dropped from almost 14 rand 80 to almost 20 rand to the dollar. Load shedding worsened, political uncertainty spiked, and global tariffs loomed. That's when Peter realized his entire retirement plan was vulnerable. He had almost no offshore exposure. Fortunately, we were able to help him diversify, legally and tax efficiently. And today, Peter sleeps easier, knowing a portion of his wealth is protected from local risks. After working with thousands of successful South African retirees, I can tell you this. Global diversification isn't a luxury, it's a necessity. Make sure you watch till the end, where I will show you the offshore investment vehicle that we use that could potentially save you thousands, if not millions of rands in taxes and estate-related costs. Hi, I'm Hardy Swart, Certified Financial Planner and a Director at Family Wealth Custodians. Over the past 15 years, I've helped thousands of South African retirees optimize their income, reduce taxes, and build a global portfolio that stands the test of time. And today, I'm going to show you 2 ways to invest offshore as a South African, why it's not just about buying dollars, and which offshore investment structure could save you thousands in taxes and estate-related fees. Before we dive in, hit that like button, subscribe to the channel, and drop a comment below. How much of your portfolio is invested offshore? And why do you think offshore investing is so important? Quick disclaimer, this video is for educational purposes only. It doesn't constitute personal financial advice. Always speak to a qualified advisor before making any big investment decisions. Let's start with the basics. Offshore investing simply means putting your money to work outside of South Africa, in international markets, currencies, and companies. It's not about hiding your money, it's about protecting your wealth, diversifying your risk, and accessing better global opportunities. With South Africa making up less than 1% of the global economy, it just makes sense to invest where the other 99% of growth opportunities are happening. Let's talk about the most common option South Africans use to get offshore exposure. The first option is feeder funds. Feeder funds are local, rand-denominated funds that invest in offshore assets. You invest in rands, right here in South Africa, and your money is fed into global funds run by top asset managers. These options are available on local platforms such as Allan Gray, 91, Momentum, Discovery, and a couple of others. You can use feeder funds inside your living annuity, tax-free savings account, and your retirement annuity within the limits of Regulation 28. And you can also use it as part of your discretionary investment portfolio, rand denominated of course. The pros are that you have easy access. You don't need any offshore allowance to invest offshore through a feeder fund. Your money doesn't leave South Africa, and it still gives you exposure to global companies and markets. The cons: your base currency still stays in rands. You don't directly own foreign currency, and you've got limited control over your tax outcomes. The second option we have as South African investors is to invest directly offshore. This means physically moving your money overseas and investing in dollars, euros, pounds, or any other global currency. As a South African resident, you're allowed to externalize up to 1 million rand per year without a tax clearance as part of your discretionary travel allowance. You can also externalize up to 10 million rand per year with a SARS tax clearance. It just takes a little bit more of admin to do that. Once your money is offshore, you can invest into global shares, ETFs, and mutual funds. You can also invest into offshore property, and you can invest into multi-currency portfolios tailored to your exact needs. The benefits of directly investing offshore are the following. You gain true foreign currency exposure. You get access to a much wider investment universe, and you reduce dependence on the rand and local events. The drawbacks? Well, there's slightly more admin, like tax clearance and reporting, and there's mistakes that can be costly if you're not guided properly. Now, a quick but critical insight. Offshore investing doesn't mean just buying US dollars. A well-diversified offshore portfolio should include exposure to multiple currencies. Here's why. Let's say your kids plan to study abroad, then let's say in Europe, then euros might make more sense. If you have UK ties, pounds might be the better currency. The Australian dollar offers long-term stability, and yes, the US dollar remains a global powerhouse. Diversifying your currency holdings helps reduce volatility and align your wealth with your goals. Once your funds are offshore and you've picked your currencies, the next step is deciding how to hold them. Let's look at two common options. The first option is an offshore investment plan. This is a direct, flexible way to invest globally through offshore platforms. The pros of an offshore investment plan is you've got full control and no lock-in period. You have transparent fee structures and direct access to currencies and assets. The cons? You must manage the tax reporting yourself. It might have estate planning implication and it can be complex if it's not structured correctly. The next vehicle you could potentially use to invest offshore, and a vehicle that we like especially for our high net worth clients, is an offshore endowment or an offshore sinking fund. These are insurance-based structures offered by life companies or international platforms. The pros of this vehicle is that tax is handled inside the investment at a flat rate of 30%. Furthermore, if you're looking at capital gains tax, the maximum rate of tax you would pay inside this vehicle is 12%. You don't need to declare offshore growth or income personally, and it's ideal for estate planning purposes, especially if you have beneficiaries nominated. When you have a beneficiary nominated on some of these vehicles, it means that if something should happen to you, you don't need to repatriate the funds back to South Africa. The funds can stay invested offshore. Also, this means you could potentially bypass executors' fees. The other big benefit is within these portfolios, you can have multi-currency exposure to a multitude of different asset classes. The cons of this structure is the fact that you have limited access for the first 5 years. So let's do a quick comparison between the features of an offshore investment plan compared with an endowment or potentially a sinking fund. First of all, when it comes to liquidity, if you invest into an offshore investment plan, you've got full flexibility, meaning that you can withdraw your funds whenever you want to. When it comes to an endowment or a sinking fund, your access is restricted for the first 5 years. And depending on the type of product you have, you might only be able to make 2 withdrawals in the first 5 years or restricted period. When it comes to tax administrations, in regards to an offshore investment plan, it's fully your responsibility. Where, to the contrary, in an endowment or a sinking fund, it's handled with inside the wrapper or the product. That means you don't have to worry about taxes since it's paid inside the vehicle. Next, when it comes to your tax rate, when it comes to an offshore investment plan, it's based on your personal marginal tax rate, which could potentially go up to 45%. Where if you look at an endowment, it's taxed at a flat rate of 30%. Capital gains. Capital gains in an offshore investment plan also depends on your own marginal tax rate, but it can be up to 18%, where in an endowment, effectively it sits at 12%. When we look at estate planning, when an offshore investment plan, it needs structuring and it does form part of your estate. There's also executors' fees payable, and there's a high likelihood that should you pass away, your external funds or your offshore funds would need to be repatriated back to South Africa. Where in an endowment, it's got automatic built-in features, meaning that you don't have to pay executors fees if there's the right beneficiaries nominated, and your funds, if correctly structured, don't need to be repatriated back to South Africa. So there's definitely a lot of estate planning benefits. And then when it comes to currency options, in both of these vehicles, you can invest into a multitude of different currencies depending on your specific need and diversification benefits. So now the question arises, which of these vehicles are the best to invest directly offshore? Well, here's the thing. It totally depends on your unique circumstances. For example, if your need is flexibility and immediate access to your funds, then an offshore investment plan might be the better option. If your need is, if you're a high income earner with a very high tax rate, then an offshore endowment might be a better option. So it really depends on what your unique circumstances are and how these respective structures fit into your overall retirement master plan. Let's wrap this up. Offshore investing can potentially protect your wealth. It provides you with access to the other 99% of global growth opportunities, and it could potentially help you to sleep better knowing that you're not overexposed to South Africa. You can start small through feeder funds or go fully global. Just make sure you structure your investment in the right way. You might want to use an offshore investment plan for flexibility, or an offshore endowment or sinking fund for tax efficiency and simplified reporting. But always remember, the world is bigger than one currency. If you're ready to take your retirement plan globally, then join our retirement community where we share weekly market insights, videos, articles, and blog posts. So if you would like to find out more, the link is in the description below. And if you have any questions or want help with your portfolio or need specific advice, reach out to our team. We'd love to support you. Don't forget to like this video, subscribe to the channel, and share it with someone who needs to start thinking globally. Thanks for watching, and remember, the world is your investment playground. Don't keep your future locked in one small corner.